So Gatekeeper System, symbol GSI on the TSX Venture, is a leading provider of intelligent video and data solutions designed to provide safer transportation environment for children, passengers, and public safety personnel on multiple transportation modes. The company breaks its operations into two segments, school and transportation. And it serves both Canadian and US markets, with the lion's share being from the US market. The company currently serves about 3,500 customer school districts across every state and province in US and Canada. The stock is currently trading at about 34 cents a share, rising 20% year to date. Gatekeeper defines its revenue model as platform as a service, or PaaS, not SaaS, PaaS, which sells its services including on-vehicle recording, GPS, video analytics, transit lane enforcement, passenger counting, mobile Wi-Fi, thermal cameras, AI dashcam, and much more as a package service on a recurring contract basis after initial setup. Like a SaaS model, you do see recurring revenue, but the company also has a bit more lumpiness because it has contracts when they're first initiated. They have the setup fees, they have hardware installed, and stuff like that. So, moving to the income statement. During fiscal Q3 2023, ending May 31st, Gatekeeper had revenue of $5.9 million, up 35% compared to the prior year, but down sequentially from the prior quarter's record revenue of $9.7 million. The large fluctuation in revenue on a quarterly basis is due to contract revenue recognition, as they had a large contract in the previous quarter. However, that is not to say the company isn't growing. The year-to-date, so 9 months, revenue was up 101% to $20.5 million. As well, notably, the gross margin for the company for the last quarter, so Q3, increased to 50% compared to 41% in the prior year, whereas the 9 months has been flat at 44%. The company has flipped into profitability, which is always great to see over the past year, with Q3 having a net income of $440,000 versus a loss of $318,000 in the prior year, with year-to-date having a net income of $2.2 million versus a loss of $800,000. As well, it is worth noting that the company is now paying taxes, which it previously in its profitable quarters was not. So going forward, you can expect taxes assuming they stay profitable. Gatekeeper was previously profitable prior to COVID-19, but saw significant revenue shrinkage and in turn then EPS turning negative as well. And in this graph, you can see it just fluctuates quite a lot on a quarterly basis. Earnings just have not been consistent so far. I will note as well that the share count only increased by from 87.6 million at the end of 2019 to 91.5 million, which is about a 4.5% increase, which isn't a massive drag on the share count like we saw some small cap companies to survive through the pandemic. They just diluted. So it is nice to see that, given they had a very material impact due to COVID, that it didn't just dilute its shares into oblivion. Additionally, the company has been able to flip into operating cash flow being positive of $563,000 for the last 9 months compared to a deficit of $3.6 million. And this is with increased working capital levels over the past 9 months. Gatekeeper has been able to lower its line of credit to only $1.6 million from $3.5 million, which is good to see given it is a variable debt at this time. It is a line of credit, so it's based off prime for whatever currency they're borrowing and plus percentage. And then so we're in a high interest rate environment over the past year compared to what we were 1 or 2 years ago. It would have been a much higher interest rate expense. As well, net debt, including leases, fell to $1.5 million from $1.9 million, offset by a decrease in cash, of course, compared to their debt. Leverage is not really a concern at this time. If the company is able to stay profitable, it's only like a 0.3, 0.4 net debt to EBITDA, so it's very low. Looking at valuations, Gatekeeper trades at a trailing price sale of only 1 time and a trailing price to earnings 7 times. And if you normalize the past 12 months for taxation, which it will, assuming it stays profitable, it will have taxes going forward. It will be about 8 to 9 times, depending on the exact tax rate they realize. So the valuation is quite cheap given the recent growth on the top and the bottom line. However, it will be a touch higher if all else equal there is taxation. So our take. The company is returning positive earnings, which is great to see, especially the last quarter having no major contract disclosures. So we see it's more coming from that recurring revenue versus you have one big contract in the next 12 months. You have nothing. It's good to see that they're actually being able to maintain a positive bottom line when it is just that recurring revenue for the most part. The balance sheet is minimally leveraged at this time, and it's recently paid down over half, which is also good to see. Moving forward, however, we would like to see sustained net income. We don't want to see those big fluctuations quarter over quarter back down negative. They were negative at the first quarter, slight negative, I should say. And previously, we saw with COVID, they crash way back down for sales and for earnings. We really need to see that sustainable to be investable, but it is on its right track. It's been diversifying between regions, expanding its operation locations, winning some big contracts, which are good going forward. But we need to see them just keep doing more of that so they can gain those sustainable earnings. So I'll open up to you guys if you had any comments.
Yeah, I mean, one thing that I'll just say, one thing that I noted is, about 500 million, or sorry, 500 million. What was it? About 2.1 million in earnings for the 6-month period, but then cash flow of only 500,000. So that's, what we would want to see, generally speaking, is that the cash flow is significantly higher than the reported net earnings in order to say that there is high earnings quality. Now, if it's 1 quarter, even 2 quarters, the cash flow can fluctuate, but that's something that you want to keep an eye on. And if it's consistently below the net income over a period of time, then we would say it's low earnings quality.
Yeah, I mean, I think I said that Q1 in the intro was a big quarter for them this year. I think it was Q2 actually that was the biggest quarter for them. Yeah, they are. But I mean, if you just look at the last 4 quarters in terms of volatility of the company, revenues in Q4 to end out last year, 9.8 million. So very strong quarter, 2.4 million in operating income. Then the next quarter, 4.9 million in revenues, lost 500,000 operational basis. Revenues in Q2 were 9.7 million. So tremendous profitability, operating basis, 2.2 million. And then if you look at revenues in the last quarter, Q3, 5.9 million and just 500,000 in profit. They stayed at a net profit, or at an operating profit, but wide fluctuation just in the past 4 quarters. And so on a trailing basis, I think those 2 quarters, the Q4 and Q2, were the best in history of the company, essentially. So yes, it makes for a low PE. Are they going to be able to do that going forward is the question with the lumpiness. So and perhaps backlog is something to really track closely if they're publishing that. And to see if that is increasing over time, because then you'd have some confidence if they can maintain a reasonable margin that, over a 12-month period, you're going to execute on that backlog. And then rolling forward, if the backlog could continue to increase, that's what you'd like to see. I mean, often when you're dealing with a company that is contract driven, it is something to look at to give you confidence that at some point you may have one poor quarter, but it may smooth out over a year. And a backlog can give you some confidence that that's going to happen. If you're flying in the dark from quarter to quarter, it's very difficult, in a contract-driven business for sure. So, I mean, Gatekeeper's interesting for sure, particularly based on the trailing valuations. I'm not sure did you track? Was there a backlog that you saw there? Did they publish something like that?
Specific backlog.
Yeah. So that would be something we'd ask. Some industries, it's far easier to do. Some companies are more willing to put it out. Some aren't, right? So, it'd be something that we'd want to look at because of the fluctuative nature on a quarterly basis, at least. And if you could continue to see an uptick in that over time, then it might give you confidence to buy it and not look just quarter to quarter on it, look more on an annual basis what they could produce. So it's interesting. We'll probably reach out to them again at some point going forward.